You ever feel like your wallet's just, I don't know, playing a cruel joke on you?
Yeah, tell me about it.
Like you put the same amount of cash in, but somehow uh, less stuff comes out. That, my friends, is the inflation roller coaster we're all riding.
It certainly feels that way sometimes.
Well, today we're grabbing a front row seat, trying to understand it better. We're looking at the latest insights from the Macro Butler.
Right, their special service newsletter, the one titled The Untold Story of Inflation.
Exactly. And we're not here for just the usual doom and gloom headlines.
No, the goal is different.
Our mission really is to equip you, the shrewd investor listening, with the real intel. What's really driving these prices?
Yeah, this newsletter, it really tries to go beyond just the surface level economic data. It's less about reporting symptoms.
And more about diagnosis.
Exactly. Diagnosing the underlying illness, at least as the Macro Butler sees it. It's aiming to give you a clearer sense of where inflation might be headed.
And crucially, what that might mean for, your investment strategy. Okay, so let's dive in. Let's start with those numbers everyone talks about. The latest CPI report.
Right. It showed a 0.2% bump month on month.
And 2.3% year on year. Lower than expected, wasn't it? Cue the celebratory air horns.
Well, not so fast. The newsletter points out that dip is largely, thanks to falling energy prices and goods.
Okay, more volatile parts.
Yeah. And even the services sector, which has been a really stubborn source of inflation, it's showing signs of slowing down.
So the Macro Butler calls it, was it a Goldilocks report?
If you squint hard enough. Yeah.
Yeah.
That little aside tells you they aren't exactly popping any champagne corks yet.
Right. Because when you kind of adjust your focus, you see core CPI, that's one without food and energy, right?
Mm-hmm.
That actually rose by 0.3% month on month. Surprise to the upside.
It did. And while the year-on-year 2.8% is the lowest since March 2021.
Which sounds good.
It does, but here's a little nugget that makes you, well, raise an eyebrow. That's 59 straight months of core CPI going up.
59. Wow. Talk about a persistent trend.
Indeed. And if you look at the bigger picture, while those core services might be hinting at a slowdown,
Yeah.
core goods have now flipped. They're actually inflationary year on year.
Oh, really?
Yeah, first time since December 2023. So that deflationary push we saw in goods might be losing steam.
Suggesting broader price pressures could be coming back.
Could be. It suggests that.
Okay. What about owner's equivalent rent? OER.
Yeah.
The financial world's favorite slow-motion train wreck.
Yeah. The newsletter notes a slight dip there, down to 4.3% year on year.
Which is the coolest it's been since March 2022. So, progress, maybe. Time to break out the party hats.
Well, the Macro Butler skepticism, it just shines right through again. Their line is, inflation definitely vanquished if you squint hard enough.
Okay, so same message. Got it.
Yeah, the point is, while some bits might be cooling a touch, the overall inflationary heat hasn't really gone away.
Right. Now let's zoom in on supercore CPI. That's core services minus housing, correct. That number dropped to 2.74% year on year, lowest since February 2020. That sounds like a reason for the Fed to maybe, I don't know, do a victory lap.
That's exactly the temptation the Macro Butler highlights. But they immediately caution, this is still way above any level that signals mission accomplished.
So the question is, are these little pockets of cooling really enough to get inflation back to the Fed's target?
That's the multi-trillion-dollar question, isn't it?
Seems like it. Okay, so how did the market react to all this? Initially, it seemed like a bit of a risk-on fiesta, right?
It did, yeah. U.S. stocks mostly climbed. The S&P 500 even managed to get into positive territory for the year.
Growth and energy stocks led the way.
They did, while the more cautious defensive stocks kind of lagged behind.
But here's the twist, right?
Yeah.
The newsletter points out this report didn't exactly spark renewed hopes for a big wave of F&D rate cuts.
Exactly. The market's now only pricing in, 2 rate cuts by year-end?
Yeah, and the odds of a July cut actually went down.
Right. So it suggests the market, maybe echoing the Macro Butler's feeling here, isn't totally convinced the inflation fight is won.
And the plot thickens.
Yeah.
The dollar actually gained strength. And gold took a bit of a tumble. But get this. The 10-year Treasury yield rose. And it rose above a key Fibonacci level.
Ooh, a technical point there.
Yeah, traders watch those levels for potential turning points. And the newsletter suggests this could signal a next leg up in the reflationary saga.
Wow. So not exactly the inflation is dead headline we might have expected from the CPI print.
Not at all.
And connecting that back to the Macro Butler's overall argument that rise in the 10-year yield, it could be the market actually anticipating, persistent or maybe even accelerating inflation despite those headline numbers looking tame.
Okay, so we've seen the numbers, we've seen the market reaction, and the Macro Butler is clearly giving the side eye to the whole inflation is conquered idea. So what's the untold story? What's their main point?
Well, the newsletter argues that March's dip, that lower CPI number, was basically just a statistical hiccup. Okay.
They believe we're actually entering what they call a Trump reflation period, and it's being fueled by new trade policies.
Tariffs.
Exactly. The core idea is pretty simple. Tariffs increase costs, and those costs, well, they have to go somewhere. Either consumers pay more or producers pay more.
Right. And they have their own index, don't they? An umbrella inflation index.
They do. It averages several key inflation metrics to get a sort of broader view. And they highlight that this index has been climbing since the disruptor-in-chief took office.
Okay, so there's skepticism about hitting that 2% inflation target by the end of the Jubilee year. It sounds pretty well-founded from their perspective.
It does. They even run the numbers. They show how unlikely it is to actually hit 2% by the end of 2025 if these monthly CPI increases stay at 0.2% or higher.
What kind of numbers are we talking?
Well, they suggest we could see year-end CPI anywhere from, say, 2.46%, which is relatively mild, up to a pretty spicy 5.8%. Whoa! That's a big range. And that raises a big question for the head D, doesn't it? Will they regret easing policy if inflation stays this high?
The newsletter certainly implies they might. Suggest it could look like a misstep in hindsight.
Okay, but shifting gears a bit. Beyond the government data and Fed policy, what does the Macro Butler see as the fundamental drivers of inflation?
They really move away from, traditional monetary theory here.
Okay.
And focus on more basic economic stuff. Shortages, demand, and crucially, a lack of confidence.
Interesting. How does that connect now?
Well, they argue that tariffs and trade wars are making shortages worse. And at the same time, geopolitical uncertainty, maybe fueled by U.S. actions, is eroding global confidence.
Which leads us nicely into their views on monetary theory.
Mm-hmm.
They specifically take on the Keynesian idea, right?
Yeah.
That inflation is mainly about expanding the money supply.
Yeah, they push back on that.
What's their counter-argument?
They make a few points. First, currency valuation matters. A weaker currency can actually pull in foreign capital.
Second, international capital flows can boost the domestic money supply, even without the central bank doing anything.
Right, money moving across borders.
Exactly. And maybe the most compelling point they make is looking at history. There's a surprisingly weak correlation between the U.S. M2 money supply and CPI inflation.
And their preferred way to measure inflation isn't even CPI, is it? It's something to do with gold and bonds.
That's right. They look at the gold-to-bond ratio compared to its 7-year moving average.
Right.
And they observe it shows basically no significant correlation with changes in M2. So they seem to believe that market signals, like how gold is valued against bonds, give a more reliable picture of inflationary pressures than just looking at M2.
So for you, the listener, maybe pay closer attention to how gold and bonds are performing relative to each other.
That seems to be their suggestion, yes, as a potential leading indicator.
They even bring up history, don't they? Like the Great Depression, the Japanese bubble.
Yeah, they use those examples of the '87 crash, the
Yeah.
Asian currency crisis, too, to really underline how powerful capital flows are.
Whether money is rushing in or rushing out.
Precisely. These flows can dramatically affect asset prices, economic stability, often quite separate from what domestic monetary policy is trying to do.
And sticking with gold for a second, they remind us that the price isn't universal, right? It depends on the currency you're using.
A really crucial point.
So what's the takeaway for investors there?
It's basically a call to consider your own currency perspective. Are you just seeing your local currency fluctuate against gold, or are you analyzing gold's underlying value? It's about context in a global market.
Okay. They also take a swing at demand-side inflation theories, particularly Keynes, arguing he missed the impact of capital flows.
Yeah, their argument is that just focusing on domestic demand and interest rates ignores how powerful global capital movements can be.
They give examples.
They point to, Paul Volcker's high rates attracting foreign capital back in the day, and also how the Fed couldn't really control markets with interest rates alone in the late 20s and early 30s. Capital flows were just too strong.
Gotcha. And it's not just about consumer prices, right? They talk about asset inflation, too.
Right. how asset prices can go up because of shortages or sometimes even oversupply. They use the California gold rush as an example.
So,
Well, the sudden flood of gold actually made gold less valuable locally, which then pushed up the prices of everything else. It reinforces their point that money's value, even gold's value, has always fluctuated.
interesting. They also tackle some more modern ideas like MMT and QE. What's the Macro Butler's view there?
Pretty critical, to be honest. They dismiss the MMT idea that countries printing their own currency can't go broke just by borrowing more.
And QE, quantitative easing.
They argue QE is mostly just a maturity swap.
Uh,
The Fed swapping short-term bonds for long-term ones. They don't think it necessarily increases the broad money supply in the way MMT folks suggest.
and they mentioned U.S. debt.
Yeah, they highlight that U.S. debt, T-bills especially, is a huge part of the global money supply. And the interest paid on that debt, well, a chunk of it goes overseas, including to places like China.
Okay, brings us back to tariffs. They call them a damaging policy. Why?
Well, they argue tariffs just don't account for complex things like currency exchange rates or those capital flows we talked about.
And the consequences.
Higher import costs, which hurts industries that need those imports. That leads to higher production costs, maybe job losses, and definitely higher prices for consumers.
And trade wars aren't simple.
Definitely not. They stress they're not linear or reciprocal. It often just becomes a damaging cycle of retaliation.
So given this whole picture, potential reflation, maybe stagflation, issues with tariffs, capital flows, what investment strategy does the Macro Butler actually recommend for what they're calling the Trump stagflation?
Well, their recommendations are pretty defensive, cautious.
What?
Favor companies with low debt, strong earnings, good free cash flow. Prioritize energy producers over consumer-focused businesses.
Bonds.
Steer clear of long-dated government bonds. Beyond 6 months, they say. Maybe actively manage cash with short-term, like sub-12-month investment-grade corporate bonds.
And the big one, hard assets.
Yeah, they recommend a significant allocation over 25% of physical gold, silver, and other hard commodities as a hedge. Anti-fragile protection against inflation and instability.
Okay, so let's just quickly recap the key takeaways from this deep dive into the Macro Butler's newsletter. They think lower energy prices are hiding persistent underlying inflation.
Right. Core goods inflation is rising now. Services slowing a bit.
They see this Trump reflation continuing, possibly shifting to Trump stagflation.
Driven by tariffs and maybe government handouts, yeah.
That 2% inflation target by end 2025, looking unlikely to them.
Very unlikely, based on their math.
They trace inflation back to fundamental issues, like shortages in confidence,
Yeah.
made worse by trade barriers.
And recommend hard assets and certain types of equities for protection.
Expect higher volatility, maybe dull inflation-adjusted returns elsewhere, gold and silver as hedges.
And importantly, that potential shift from an inflationary boom to an inflationary bust stagflation may be in the coming months.
They also make a point about collapsing public confidence leading to economic trouble, right?
Yeah, drawing historical parallels there. And emphasizing that consumers and businesses tend to lose out in trade wars.
So the bottom line from the Macro Butler's untold story of inflation seems to be a real word of caution for you listening. Don't get complacent because of one CPI report.
Definitely not. They see potential stagflation coming, driven by trade policy and maybe falling confidence.
Their advice: ditch long bonds, focus on strong, low-debt companies, and consider those traditional safe havens like gold and silver.
Pretty clear recommendations.
And they leave us with that really provocative thought, don't they? Drawing parallels with history, where eroding confidence led to economic hardship, suggesting this decade might follow a similar path. Definitely some food for thought there, beyond the usual market chatter.
Absolutely. A lot to consider for your own strategy.